Hello friends, so welcome to the another video. In this video, we're gonna cover some important questions of financial planning. So let's get started. The first question is, Aditya is having INR 11,500 with him available for investment for the next 10 years, though only on monthly basis. Suggest appropriate investment alternative to him in the following scenarios when he wants to have an amount available at the beginning of 11th year. And the scenarios, there are three scenarios in this question. The first is Aditya is a risk averse. Aditya can take a moderate risk, and Aditya is ready to take calculated risk. So let's take the answer. The very first scenario for which Aditya is a risk averse. So the investment options available for this is FDs or public provident fund, that is PPF. So FDs, Aditya can invest his money in monthly fixed deposit with a reputable bank. This option offers guaranteed return and is considered very safe. So interest rate for the FDs are 5 to 7% per annum, and FDs can be prematurely withdrawn, but there may be penalties. For PPF is a government-backed long-term savings scheme that offers tax benefit and a fixed rate of interest. Current rate is around 7.1 per annum. But the one problem is PPF is there is a locking period of 15 years, but partial withdrawals are allowed after the 7th year. So the recommendation here in this case is, if you prefers liquidity, go for FDs, and if you want a better tax efficiency and is okay with longer lock-in periods, then PPF is the best choice. Now second case, when Aditya can take moderate risk, the options available are balanced mutual funds or the equity linked savings schemes. So balanced mutual funds are invested in mix of equity and debt, providing moderate risk exposure while aiming for capital appreciation and regular income. So expected return is 8 to 10% per annum in balanced mutual funds. Equity linked savings scheme is a type of mutual fund that invests primarily in equities and offer tax benefit under section 80C. Expected return is 10 to 12% per annum over a long term. So recommendation here in this case could be Aditya could consider investing in systematic planning, investment planning SIP in a balanced mutual funds or ELSS to benefit from rupee cost averaging while still having some level of safety. Now the third case, when Aditya is ready to take calculated risk, the options available are equity mutual funds or direct equity investment. So equity mutual fund primarily invest in stocks and can offer sufficient growth potential over long-term investment horizon. So expected return could range from 12 to 15% per annum. And a direct equity investment can directly invest in stocks of companies that he believes will perform well for the next decades. So here the expected returns are very widely based on market performance and the chosen stock, but can significantly higher than mutual funds. So the recommendation in this case is investing through SIPs in diversified equity mutual funds would be prudent for calculated risk. If he has a good understanding of the stock market, he could also consider allocating a portion of his investment to direct equity. So this was the question with three parts: when Aditya is a risk taker, moderate risk, and when he don't want to take a risk at all. So different alternatives available to him. Moving to the next question, that is, critically analyze the following investment alternatives in terms of their concept, advantages, disadvantage, and suitability. The first is fixed deposit, PPF, PF, Sukanya Samriddhi Yojana, and index funds. So let's start with the fixed deposit, the very first. So fixed deposit is a financial instrument provided by banks and financial institutions that allow investor to deposit a lump sum amount for a fixed tenure at a predetermined interest rate. So the advantages of FD are because it is considered safe with low risk, are considered low risk investment, and they have a fixed guaranteed return, fixed interest rate. Liquidity, many banks allow premature withdrawal, and disadvantage here can be low returns. The interest rate of FDs are generally lower than inflation. Taxation, interest earned is fully taxable, which can reduce the net returns, and lack of growth potential in FDs. So the advantages of FDs are, it is safe, it has guaranteed return and liquidity. The disadvantages, the return is very low and it's taxable and lack of growth potential. So what is the suitability for FDs? So it's suitable for risk-averse investors seeking stable return and capital preservation, especially for short-term to medium-term goals. Moving to the second, that is PPF, Public Provident Fund. So it's a long-term saving scheme backed by the Government of India that offers tax benefit and attractive interest rate compound annually. So the advantages, the very first can be tax benefit under the section 80C. Second is it's a government backed, so it's carry minimal risk, compounding benefit also. So interest is compounded annually, enhancing growth over time. The disadvantage here in PPF can be that it has a mandatory lock-in period of 15 years, and it has limited contribution at rupees 1.5 lakh annually, and partial withdrawal. While partial withdrawal are allowed after 7 years, they are limited on. So suitability can be, PPF is suitable for long-term investors looking for a safe investment with tax benefit and willing to lock in their funds for an extended period. So let's see the advantages once again. Tax benefit, government backed, compounding benefit. Disadvantages can be lock-in period, limited contribution and partial withdrawals. The third is PF, Provident Fund. So Provident Fund is a retirement savings scheme where both the employee and employer contribute a portion of the salary to the fund managed by the employee's Provident Fund organization. So advantages, the employer also contribute in this fund. Tax benefit, contribution equalify for tax deduction and the interest earned is tax free. Retirement security provides financial security post-retirement. The disadvantages, withdrawal is restricted. There are restrictions on when and how much can be withdrawn before retirement. Low returns, the interest rate is relatively low compared to other investment options, and limited control. Investors have very limited control over the investment choices. Suitability is, PF is suitable for salaried individual looking for a long-term retirement saving with the benefit of employer contribution and tax advantages. So moving to the fourth, that is Sukanya Samriddhi Yojana. Again, it's a government-backed saving scheme aimed at encouraging parents to save for their daughter's education and marriage expenses. The advantages here are high interest rate. This offers an attractive interest rate, generally higher than traditional saving bank. Again, tax benefit under the section 80C and government assurance as it's a government scheme and it carries minimal risk. Disadvantages, again, here it is lock-in period until the girl turns 21 old or get married after 18. So limited eligibility, only applicable for the girl child. One family can open accounts for up to 2 daughters. Contribution limit is also there. The maximum annual contribution is capped at 1.5 lakh. Now suitability is, SSY is suitable for parents looking to save specifically for their daughter's future needs with a focus on long-term growth and security. The very last is index fund. So index fund are mutual funds that aim to replicate the performance of a specific market index such as Nifty 50 or Sensex by investing in the same securities in the same proportion. So the advantages, it provides diversification, exposure to a wider range of stocks within the index, lower cost. Index fund typically have a lower expense ratio compared to actively managed fund due to passive management. Market performance, they aim to manage market returns with which can be beneficial in bullish market. And disadvantage here is market risk, limited flexibility because fund managers cannot make active investment decisions to respond to market change. Potential underperformance in bear market. In declining market, index funds will also experience losses. So index funds are suitable for long-term investors who are comfortable with market risk and seek a cost-effective way to invest in equities without active management. So these are the 2 questions for this video. Thank you, stay tuned and all the very best for your exams.